You open your charts, the candles move up, down, up again, and somewhere inside your mind, a quiet expectation forms. You want to know what happens next, not later, not eventually. You want to know times now. Because if you could just know the next move, if you could predict the next candle, if you could catch the turn before everyone else sees it, then trading would finally feel safe. This is the invisible promise most traders chase. Certainty. And the strange part is, no one sits you down and says it out loud. No one tells you, you must be certain to win. But everything around you quietly pushes you toward that belief. You watch charts on the smallest time frames. You stare at every tick. Every tiny move feels like information. Every fluctuation feels meaningful. You feel like if you just focus hard enough, if you just watch closely enough, if you just react fast enough, you'll gain control. But the market was never designed to give you certainty. It was designed to give you probability. That difference may sound small, but it changes everything about how you trade, because probability doesn't promise you that this trade will work. Probability only promises that over time, a certain behavior tends to produce a certain result. And when most traders hear that something inside them resists, your mind doesn't like uncertainty. It wants closure. It wants resolution. It wants the emotional relief that comes from knowing what happens next. So you do what most beginners do. You shrink your view. You zoom in closer and closer. 1 minute, 30 seconds. Tick charts. You begin reacting to noise as if it were signal. And at first, it feels exciting. Fast decisions, quick entries, immediate feedback. But beneath that excitement, another feeling slowly appears. Tension. Because when every candle matters, every candle also threatens you. A tiny move against your position suddenly feels huge. Your heart rate increases. Your focus narrows. You stop seeing the market as a flowing environment of probabilities and start seeing it as a series of personal battles. Win this one, avoid losing that one. And the emotional pressure builds. Professional traders see something very different. They look at higher time frames, and when beginners first hear this, they often misunderstand it. They think professionals use higher time frames because they're slower or because they don't want to watch the charts all day. But the real reason runs much deeper than that. Higher time frames force you to accept the truth of probability. They remove the illusion that every small movement means something. They stretch your perspective. When you look at a very small time frame, every flicker feels like a decision point. But when you step back, when you look at the broader movement, you start seeing something different. Structure, rhythm, breathing space between decisions. And with that space, your mind begins to calm down, because something subtle happens when you stop staring at every tick. You stop trying to control every moment. Instead, you begin allowing the probabilities to unfold. Most beginners resist this. They feel like they're missing opportunities. They feel like they're late. They feel like something important might happen without them. But that feeling, that fear of missing out, is one of the strongest forces that pulls traders into chaos. It pushes you into trades that were never part of your plan. It convinces you that speed equals skill. And slowly, without realizing it, you build a relationship with the market based on urgency. Professional traders build a relationship based on patience. And patience is not about waiting randomly. It's about trusting that your edge does not need constant action. An edge is simply a pattern that tends to play out over time. Not every time, over time. That means every individual trade is just one event inside a much larger distribution. Imagine flipping a coin that lands heads slightly more often than tails. You cannot know what the next flip will be. But if you flip it hundreds of times, a pattern emerges. Trading works the same way. But when you watch the market on extremely small time frames, you lose sight of that distribution. Every trade suddenly feels like the times that must prove you right. Every loss feels like a failure. Every win feels like relief, and that emotional roller coaster slowly begins to shape your decisions. You hold winners too tightly. You exit too early. You hesitate when your setup appears. You jump into trades that were never part of your plan, not because you lack intelligence, not because you lack effort, but because your mind is trying to escape uncertainty. Higher time frames interrupt that cycle. They force a different relationship with the market. Instead of reacting to every movement, you begin observing behavior. Instead of chasing every opportunity, you begin waiting for alignment. Instead of trying to predict the next candle, you begin trusting the process. And something remarkable happens when that shift begins. Your emotional pressure decreases. Your decisions become clearer. Your trades become fewer but more intentional. The market stops feeling like a chaotic storm and begins feeling like a landscape. And landscapes reveal themselves slowly. But to understand why this shift is so powerful, you first have to look at the invisible traps your mind sets for you. Because the real battle in trading is not between you and the market, it's between you and your own perceptions. The human mind evolved to survive environments where uncertainty meant danger. If you hear a sound in the dark, your brain wants to know immediately what caused it. If something moves quickly in your peripheral vision, your brain demands instant interpretation. This survival instinct helped humans navigate a world filled with real threats. But in trading, that same instinct becomes a source of distortion because the market is not trying to harm you. It is not reacting to you. It simply moves based on countless decisions made by millions of participants. And those decisions create waves of probability. But when you stare at the screen, your mind begins interpreting those waves as personal signals. You see a sudden move upward, your brain whispers, you're missing it. You see a quick drop, your brain whispers, something is wrong. You see the market stall, your brain whispers, act now before it's too late. These whispers feel like intuition, but more often, they are simply emotional reactions to uncertainty. Fear of missing out, fear of losing, fear of being wrong, greed for just a little more profit, attachment to the idea that this trade times must times work. All of these emotions distort your perception. They narrow your focus until the only thing that matters is the immediate outcome of the current trade. And once your mind becomes attached to that outcome, objectivity disappears. You begin interpreting every movement in a way that protects your position. If the trade moves in your favor, you feel confirmation. If it moves against you, you search for reasons to stay. You delay decisions. You hesitate. You rationalize. And slowly, your behavior drifts further away from probability-based thinking. This is where most traders lose their edge. Not because their ideas were wrong, but because their emotions reshaped their actions. Professional traders are not immune to these emotions. They feel them too. The difference is that they build systems that protect them from acting on those emotions. One of those systems is perspective. Higher time frames create distance between stimulus and reaction. They reduce the number of decision points your mind must process. They give you time to observe instead of react. And in that space, something powerful becomes possible. Awareness. You begin noticing the emotional impulses that used to control you. You notice the urge to jump in early. You notice the discomfort of waiting. You notice the desire to move your stop to protect your ego rather than your capital. Most beginners never reach this level of awareness because they are constantly reacting. Their mind is trapped in a cycle of immediate stimulus and immediate response. But when you slow the pace, when you expand your perspective, you begin seeing your own thinking more clearly. You start recognizing the subtle distortions. The moment when greed whispers, the moment when fear tightens your chest, the moment when overconfidence makes you believe the market owes you something. And once you can see those moments, you gain a choice. You can either follow the impulse or return to probability. This is where real discipline begins, not the rigid discipline of forcing yourself to follow rules out of fear, but the quiet discipline that comes from understanding how the mind works. You begin to realize something important. The market does not require you to be right. It only requires you to be consistent. Consistency means applying your edge the same way over and over across a large number of trades. But consistency becomes impossible if every trade carries emotional weight. If each outcome feels like a verdict on your intelligence, your worth, your ability, professional traders remove that weight. They see each trade as one event inside a much larger sequence. They know that even a strong edge will produce losses. They know that uncertainty cannot be eliminated. So instead of trying to avoid it, they accept it. And that acceptance changes how they build their approach. They begin defining their edge clearly, not as a vague feeling, not as a reaction to the latest movement, but as a set of conditions that historically align with probability. Those conditions become rules, simple, clear, written, because once your rules exist outside your mind, they stop changing based on your emotions. You know exactly what must happen before you act. You know exactly how much risk you accept. You know exactly where your trade becomes invalid. And this clarity removes a huge amount of psychological pressure because the decision is no longer happening in the heat of the moment. It was already made. Your job is simply to execute. Many traders resist this structure because it feels restrictive. They believe freedom in trading means doing whatever feels right in the moment. But real freedom appears when your decisions no longer depend on your emotional state. When your process becomes consistent, your mind becomes calm. You wake up knowing exactly what you are looking for. You observe the market without urgency. You wait for your conditions, and if those conditions never appear, you do nothing. That ability to do nothing is one of the strongest signs of a developing professional mindset because it means you are no longer chasing the market. You are allowing the probabilities to come to you. Higher time frames support this discipline because they reduce the temptation to overreact. They stretch the timeline of your decisions. They remind you that the market is not defined by the last 5 minutes. It is defined by behavior unfolding across hours, days, sometimes even longer. And when you align your perspective with that broader behavior, something remarkable happens. Your edge becomes clearer, your trades become more deliberate, and your emotional swings begin to fade. But none of this works unless you truly accept the role of risk, because probability cannot exist without risk. Every trade carries uncertainty. No matter how strong your edge appears, no matter how confident you feel, the outcome of any single trade is always unknown. Most beginners say they understand this, but their behavior reveals something different. They move stops when the trade gets close. They reduce their position size after a loss. They increase it impulsively after a win. They hold losers hoping they will turn around. All of these behaviors share the same root. They are attempts to avoid the emotional discomfort of risk. But avoiding risk in trading creates a paradox. The more you try to eliminate it, the more your decisions become emotional. Professional traders resolve this paradox in a simple way. They define their risk before entering the trade, not as an afterthought, not as something flexible, but as a fixed cost of participation, just like a business pays rent. Once the trade is placed, that risk is already accepted emotionally, mentally, completely, because the moment you accept that risk, the market loses its power to surprise you. If the trade fails, it simply fulfills the possibility you already acknowledged. If it succeeds, it becomes one more data point in your probability distribution. Higher time frames make this acceptance easier. They encourage wider stops that reflect meaningful structure rather than tiny fluctuations. They reduce the temptation to interfere with a trade based on small movements. They create space for the market to breathe. And that breathing space aligns your behavior with probability. But even with a well-defined edge and clear risk, losses will happen. sometimes several in a row. This is where many traders lose their confidence. They begin questioning everything, their strategy, their rules, their ability. But losses are not the enemy. They are information. The key is learning how to interpret that information without judgment. Instead of asking, why did I lose? You begin asking a different question. Did I follow my process? If the answer is yes, then the loss is simply part of the distribution. No change required. If the answer is no, then the loss reveals a behavioral error, an opportunity to refine your discipline. This shift in perspective transforms how you experience setbacks. Losses stop feeling like personal failures. They become feedback, and feedback accelerates growth. Over time, a pattern begins to emerge. You start seeing how your emotional impulses used to interfere with your edge. You notice how patience improves your results. You notice how consistency stabilizes your equity curve. And gradually, your confidence stops depending on the outcome of individual trades. It begins depending on the strength of your process. This is the moment when trading starts to feel different, quieter, more balanced, less dramatic. You stop celebrating wildly after wins. You stop spiraling after losses because both outcomes are simply part of the same system. And as that emotional balance deepens, you enter what many traders call the zone, not a mystical state, just a condition where your actions align naturally with probability. You see the market clearly. You follow your rules without resistance. You accept outcomes without emotional turbulence. Maintaining this state requires ongoing awareness. Drawdowns will still occur. The market will still produce periods where your edge underperforms. During those times, your discipline becomes your anchor. You remind yourself that probability unfolds across large samples. You protect your capital. You preserve your mental energy. You continue executing your process, and slowly the distribution plays out. Wins return. Momentum builds again. But by this stage, the wins feel different. They no longer define you. They simply confirm that your consistency is working. This is why professional traders trust higher time frames. Not because they are easier, not because they guarantee profits, but because they support the mindset required for probability-based thinking. They reduce noise. They create patience. They align your perception with the larger movements that shape the market. Most beginners overlook this because they are searching for certainty. But the moment you stop demanding certainty, something powerful happens. You begin operating in harmony with the market instead of fighting it. You accept uncertainty as the price of opportunity. You trust your edge to play out over time. And in that quiet acceptance, you gradually become a different kind of trader, one who no longer needs to know what the next candle will do, because you finally understand something deeper. You don't need to control the next moment. You only need to remain consistent across many moments. And when you truly internalize that truth, the market stops feeling like a battlefield. It becomes an environment where patience, clarity, and disciplined thinking quietly compound into lasting success. And once that realization begins to settle inside you, something subtle starts to change. You stop looking at the market the way you used to. Before, every candle felt like a message you had to decode immediately. Every movement felt like an urgent signal demanding action. But now, you begin to see something you couldn't see before. Most of those movements meant nothing. They were simply noise inside a much larger process. The strange thing about noise is that it becomes louder the closer you stand to it. If you place your ear right next to a machine, every vibration sounds dramatic. Every tiny shift feels important. But when you step back, when you create distance, the noise blends together into something almost invisible. This is exactly what happens when you begin trusting higher time frames. The market hasn't changed, but your relationship with it has. You are no longer reacting to every vibration. You are observing the rhythm, and rhythm is something the mind can understand. Rhythm unfolds slowly. It carries patterns that reveal themselves over time. But when you live on the smallest time frames, rhythm disappears. All you see are fragments. A quick spike upward, a sudden drop, a candle that looks promising one moment and threatening the next. And because your brain is wired to search for meaning, it tries to assemble these fragments into a story. But the story keeps changing. One minute you feel confident, the next minute you feel doubt, then excitement, then fear. Your emotions begin following the movement of the chart second by second. This constant emotional fluctuation drains something very important, your mental energy. Most traders never realize how exhausting this process is. They think their fatigue comes from studying charts or analyzing trades, but the real exhaustion comes from emotional volatility. When your mind swings between hope and fear dozens of times every hour, it slowly wears down your ability to think clearly. Decisions become impulsive. Your patience disappears. Your discipline weakens. And once discipline weakens, your edge begins to dissolve. This is why so many traders feel stuck. They spend years learning strategies, watching tutorials, studying setups, yet their results remain inconsistent. Not because the strategies are wrong, but because their mental environment is chaotic. Imagine trying to make calm decisions while standing in the middle of a crowded intersection with cars rushing past you from every direction. That is what trading tiny time frames often feels like. There is no space to breathe, no room for perspective, just constant motion. Professional traders deliberately step out of that intersection. They observe the flow from a distance, not because they lack skill, but because they understand how the mind works. They know clarity requires space, and space is something higher time frames naturally provide. When you look at the market through a wider lens, the urgency begins to fade. You notice that movements unfold over longer periods. You see that the market often takes hours, sometimes days, to express the full potential of a move. This realization changes how you experience time. Instead of feeling rushed, you begin feeling patient. Instead of chasing every opportunity, you start waiting for alignment. And waiting in trading is not passive, it is active awareness. You observe the market with curiosity rather than anxiety. You watch how it behaves. You notice how it expands, how it pauses, how it shifts direction, and slowly your understanding deepens because the market is not random chaos. It is structured randomness. This means that while individual moments are unpredictable, larger patterns tend to repeat, not perfectly, but often enough to create an edge. Higher time frames make these patterns easier to see. They smooth out the noise. They reveal the broader movements that smaller charts often hide. But something else happens during this shift. Your identity as a trader begins to change. Before, you might have measured your progress by how many trades you took, or how quickly you could react, or how often you were right. But those measurements quietly encouraged a dangerous mindset. They encouraged you to treat trading like a game of immediate outcomes. Professional traders measure something different. They measure consistency, not over one day, not over one week, but over a long sequence of decisions. And when you begin focusing on consistency, the way you approach each trade changes dramatically. You stop asking, will this trade win? Instead, you ask a much more powerful question. Does this trade align with my process? That single shift removes a tremendous amount of emotional pressure because now your success is not defined by the market's next move. It is defined by your behavior. Did you follow your rules? Did you manage your risk? Did you execute your edge exactly as designed? If the answer is yes, then the trade was successful. regardless of outcome. And when you begin evaluating your trades this way, something remarkable happens. Your confidence stops fluctuating with every win and loss. It becomes anchored to something stable, your process. This stability allows you to endure one of the most difficult aspects of trading, drawdowns. Even the best traders experience periods where losses cluster together. This is not a flaw in the system. It is simply how probability distributions behave. But for someone who expects certainty, a drawdown feels like proof that something is wrong. Fear begins whispering. Maybe the strategy stopped working. Maybe the market changed. Maybe you're not good enough. And once those whispers grow louder, many traders abandon their plan. They change strategies. They search for new indicators. They jump from idea to idea, hoping to escape the discomfort. But every time they restart, they reset the probability cycle. They never stay consistent long enough for their edge to play out. Higher time frames naturally reduce this emotional instability because fewer trades mean fewer decision points, and fewer decision points mean fewer opportunities for emotional interference. This slower rhythm allows you to observe your performance across meaningful sequences rather than reacting to every short-term fluctuation. You begin seeing the bigger picture, and the bigger picture is where probability lives. But embracing this perspective requires something deeper than strategy. It requires trust, not blind trust, not stubborn trust, but informed trust built through observation and repetition. You observe your process. You document your trades. You study how your edge behaves over time. And gradually, patterns begin to emerge. You notice how certain conditions align before your best trades. You notice how patience improves your timing. You notice how emotional decisions often lead to unnecessary losses. This learning process transforms your relationship with mistakes. Instead of feeling shame after a loss, you feel curiosity. You ask questions. What did I see? What did I feel? Where did I follow my plan? And where did I drift away from it? Each answer strengthens your awareness, and awareness is the foundation of mastery. Because once you can see your patterns, you gain the ability to change them. You begin catching emotional impulses before they become actions. You notice when fear tries to push you out of a trade too early. You notice when greed tempts you to hold longer than your plan allows. You notice when boredom tries to convince you that you need to trade even though nothing meaningful is happening. These moments used to control you. Now they become signals reminding you to return to your process. And every time you choose discipline over impulse, your identity as a trader strengthens. Slowly, the market stops feeling like an unpredictable opponent. It becomes something closer to a mirror. It reflects your mindset. When you are impatient, your results reveal impatience. When you are disciplined, your results reveal discipline. This mirror can feel uncomfortable at first because it shows you truths about yourself you may have avoided, but it also offers something incredibly valuable: growth. Every loss, every mistake, every moment of hesitation becomes part of a larger transformation. You are not just learning how the market behaves. You are learning how times behave. And once you understand your own patterns, you gain the power to reshape them. Higher time frames support this transformation because they slow everything down. They create room for reflection, room for awareness, room for intentional decisions rather than emotional reactions. And over time, the difference between your old self and your new self becomes obvious. Before, trading felt like a constant battle. Now it feels more like a craft, something you practice patiently, something you refine over time. You no longer feel the need to prove anything with a single trade. You simply execute your edge again and again with quiet confidence. And that quiet confidence creates something many traders spend years searching for: mental freedom, freedom from the constant need to be right, freedom from the emotional spikes that come with every chart movement, freedom from the belief that success must happen immediately. Instead, you begin experiencing trading as a long-term process, a sequence of decisions that compound over time. Each disciplined action adds another brick to the foundation. And that foundation grows stronger with every passing month. This is where the true power of patience reveals itself. Because patience is not about waiting endlessly. It is about trusting that the right opportunities will appear when conditions align. Higher time frames make those alignments clearer. They highlight the moments when probability shifts in your favor. And when those moments appear, you act calmly, deliberately, without hesitation, because your preparation removed the uncertainty that once paralyzed you. You know your risk. You know your plan. You know your edge. Everything else becomes irrelevant. And when the trade ends, regardless of outcome, you return to observation. You study, you learn, you refine. This cycle continues quietly, consistently. Over time, something remarkable happens. Your results begin reflecting your mindset, not overnight, not dramatically, but steadily. Your losses remain controlled. Your winners gradually outweigh them. Your confidence grows not from hope, but from evidence. Evidence that discipline works. Evidence that probability rewards consistency. Evidence that patience truly has an edge. And perhaps the most surprising realization of all is this: the market never needed to change for you to succeed. Only your perspective did. Once you stop demanding certainty, once you accept probability as the natural language of markets, everything begins to make sense. You understand why professionals step back from the noise. You understand why they trust higher time frames. You understand why patience often outperforms speed. Because in the end, trading is not about predicting the next move. It is about aligning yourself with the forces that unfold over time. When you learn to do that, the market becomes less intimidating, less mysterious, less emotional. It becomes something you can navigate with calm awareness. And that calm awareness is what separates the trader who constantly struggles from the trader who quietly endures, adapts, and grows stronger with every passing cycle. There is a moment in every trader's journey when the noise finally begins to lose its grip on you. Not all at once, not in some dramatic flash of insight, but gradually, quietly, almost like the fog lifting from a landscape you've been staring at for years. At first, you barely notice it. The charts still move the same way. The candles still form the same patterns. The market still expands and contracts with the same restless energy. But something inside you feels different. The urgency that once lived in your chest begins to fade. You no longer feel that constant pull to act, to chase, to respond immediately to every movement on the screen. Instead, there is space, and that space changes how you see everything. Before, when a trade moved against you, your body reacted instantly. Your shoulders tightened, your stomach sank, your mind raced through possibilities. Maybe you should close early. Maybe you should move the stop. Maybe the market is about to reverse. Those thoughts used to arrive so quickly that you believed they were logic. But they were never logic. They were emotional defenses. Your mind trying to escape discomfort. And discomfort in trading often appears the moment uncertainty becomes real. When a trade is moving in your favor, uncertainty hides behind optimism. You imagine the profit growing. You picture the outcome you want. But when the market moves against you, even slightly uncertainty steps into the light. Now the outcome feels threatened, and the mind reacts. It tries to regain control. It searches for ways to remove the risk. But risk cannot be removed, only accepted. This is one of the deepest truths in trading, and it is also one of the hardest to internalize. Because acceptance is not something you declare once. It is something you practice repeatedly. Every trade invites you to accept uncertainty again. Every trade asks you to remain calm in the presence of the unknown. Most beginners never reach that level of acceptance because they are constantly trying to reduce uncertainty through speed. They believe that if they react quickly enough, if they monitor every small movement, they can stay ahead of the market. But reacting faster does not reduce uncertainty. It only increases emotional involvement. Higher time frames change this relationship completely. When you begin trusting them, you no longer expect the market to behave perfectly within minutes. You understand that movements develop over longer periods. You give the trade room to evolve. And because you have already defined your risk, you no longer feel the need to interfere with every fluctuation. This is where emotional resilience begins to grow. Resilience does not come from avoiding losses. It comes from experiencing them without losing clarity. You take the trade. You accept the outcome. You move on. No drama, no self-criticism, no desperate attempt to recover immediately. Each loss becomes just another event in the sequence. And once you begin treating losses this way, something very important happens. They stop controlling your behavior. Most traders carry emotional residue from their last trade into their next one. A loss creates frustration. A win creates excitement. Both emotions distort perception. After a loss, you may hesitate even when your setup appears. After a win, you may become overconfident and take trades that do not meet your criteria. This emotional carryover creates inconsistency. But when you operate from a place of acceptance, each trade stands alone. Your last result does not influence your next decision. You simply return to observation. You wait. You execute when your conditions appear. This ability to reset emotionally is one of the most valuable skills a trader can develop. And again, higher time frames support this skill naturally because when trades unfold over longer periods, the market forces you to slow down. You cannot jump in and out constantly. You cannot react to every impulse. Instead, you must learn to sit with the process. And sitting with the process reveals something many traders overlook. Time itself is an ally. When you rush through trades on smaller charts, you compress your learning. You experience many outcomes quickly, but you rarely pause long enough to understand them. Everything blurs together: wins, losses, emotions, reactions. But when trades take time to develop, you gain opportunities to observe yourself. You notice your thoughts. You notice your impulses. You notice how your confidence rises and falls. This awareness becomes a teacher. It shows you exactly where discipline breaks down. It shows you where fear still exists. It shows you where patience still needs to grow. And once you see these patterns clearly, you can begin strengthening your process. You refine your rules. You define your routines. You create boundaries that protect your edge. A routine might sound simple, but routines are powerful because they create stability. Imagine starting each trading day the same way. You review your previous trades. You examine whether you followed your process. You remind yourself of your risk parameters. You observe the broader market structure without urgency. This ritual prepares your mind. It centers your attention. It reminds you that trading is not about excitement. It is about consistency. Over time, these routines become habits, and habits reduce the mental effort required to stay disciplined. Instead of fighting yourself every day, your behavior begins aligning naturally with your rules. The market still tests you. It always will. There will be moments when the price moves quickly and temptation whispers that you should jump in. There will be moments when a trade approaches your stop and hope tries to convince you to hold longer. There will be moments when boredom makes you feel like you should take action just to feel engaged. But now you recognize these moments. You see them as emotional signals rather than instructions. And because you see them clearly, they lose their power. You return to your process. You trust the edge you have built. Trust is not blind belief. It is confidence earned through repetition. When you have followed your rules, Hundreds of times, when you have studied your results across many trades, you begin understanding something deeply. Your edge does not need perfection. It only needs consistency. This realization removes a tremendous burden from your mind. You no longer expect yourself to predict the market perfectly. You no longer expect every trade to succeed. You simply focus on executing the process. And with that shift, your energy changes. Before, trading might have felt like an emotional roller coaster. Moments of excitement followed by moments of disappointment. Moments of confidence followed by moments of doubt. But now, your emotional landscape becomes smoother. You still care about your results. Of course you do. But you are no longer controlled by them. Your focus stays on the long-term distribution of outcomes. You know that if your edge remains intact and your discipline remains consistent, the probabilities will eventually express themselves. And when they do, the results compound quietly. This compounding is rarely dramatic. There are no sudden explosions of success. Instead, there is steady growth, small gains accumulating over time, confidence building through experience, discipline strengthening through repetition. This quiet progression often goes unnoticed by others. From the outside, it may look uneventful, but internally, the transformation is profound because you are no longer the trader who chases certainty. You are the trader who accepts probability. You are no longer reacting to the market's noise. You are aligning with its structure, and that alignment creates a sense of harmony. Trading stops feeling like something you must conquer. It becomes something you participate in. You observe. You act when conditions align. You step back when they do not. And through this rhythm, you preserve your most valuable resource, your mental clarity. Clarity allows you to see opportunities that impatient traders miss. Clarity allows you to hold positions without emotional turbulence. Clarity allows you to step away when the market offers nothing meaningful. Over time, this clarity becomes part of who you are. It shapes the way you think, not only in trading, but in other areas of life. You become more patient, more reflective, less reactive, because the lessons the market teaches are not just about charts. They are about mindset. They are about learning to operate effectively in environments where certainty does not exist. And that ability, once developed, becomes incredibly powerful. You begin trusting processes rather than outcomes. You begin valuing discipline more than excitement. You begin understanding that progress often happens slowly, quietly, beneath the surface, just like the market itself. The market does not reveal its full movement in a single candle. It unfolds gradually, one step at a time. And in many ways, your development as a trader mirrors that process. Each trade, each observation, each moment of discipline adds another layer to your foundation. There will still be challenges ahead, moments when doubt returns, periods when results feel slower than you expected. But now you understand something that many traders never discover. Success in trading is not about finding certainty. It is about building the mindset that thrives within uncertainty. And once that mindset takes root, the market no longer feels like an unpredictable storm. It feels like a vast landscape of probabilities, a landscape where patience reveals opportunity, where discipline protects your capital, where consistency quietly shapes your future. And as you continue walking this path, something remarkable becomes clear. The trader you are becoming is not defined by a single win or loss. You are defined by the steady, deliberate choices you make day after day, trade after trade, moment after moment, as you learn to operate in harmony with the rhythm of probability. And the longer you remain in that rhythm, the more you begin to notice something that once felt impossible. The market starts feeling quieter, not because the candles move less, not because volatility disappears, but because your mind is no longer reacting to every movement as if it were a threat or a promise. There was a time when every tick pulled at your attention. A tiny move upward felt like confirmation. A tiny move downward felt like danger. Your emotions followed every fluctuation, almost like a string tied between your mind and the chart. But now that string begins to loosen. You watch the market the way someone watches the ocean. Waves rise, waves fall, but the ocean itself remains steady. This shift in perception is not something you force. It emerges naturally once you fully accept what trading really is: a probability game played across time. Most beginners try to compress this game into very small windows. They want answers quickly. They want results immediately. They want every trade to reveal its outcome right away. But probability does not work on that schedule. Probability unfolds slowly, and the trader who understands this stops trying to rush the process. Instead, you begin working with time rather than against it. You allow trades to develop. You allow sequences of outcomes to reveal patterns. You allow your edge to express itself through repetition. This patience becomes one of your greatest advantages because most traders still operate from urgency. They feel pressure to be active, pressure to find something happening right now, pressure to justify the time they spend watching charts. But activity does not equal progress. Sometimes the most profitable decision is simply to wait. Waiting does not mean doing nothing. Waiting means observing with intention. It means allowing the market to reveal whether conditions truly align with your process. Higher time frames make this type of waiting easier. They slow the environment. They create longer spaces between decisions. And inside those spaces, your mind stays clear. Clarity is one of the most valuable assets a trader can possess because clear thinking protects you from emotional traps. And emotional traps appear most often during periods of stress. One of those periods is the drawdown. Every trader eventually encounters a stretch where losses accumulate, not because the edge disappeared, but because probability sometimes clusters outcomes in ways that test your patience. When several trades fail in a row, the mind immediately begins searching for explanations. Maybe the strategy stopped working. Maybe the market conditions changed. Maybe you made a mistake you cannot yet see. These thoughts can quickly spiral into doubt. And doubt is dangerous because it tempts you to abandon consistency. But if you have studied your edge, if you have tracked your performance, you understand that drawdowns are part of the distribution. They are not proof that the system failed. They are simply one phase within a larger cycle. Professional traders prepare for these phases in advance. They know that protecting their mindset during drawdowns is just as important as protecting their capital. So they reduce emotional exposure. They maintain their routines. They continue following their process without chasing recovery, because chasing recovery is one of the fastest ways to destroy discipline. When a trader feels the need to make it back quickly, the focus shifts away from probability. Now, the goal becomes emotional relief. And emotional relief is not a reliable trading strategy. Higher time frames help neutralize this impulse. Since trades occur less frequently, the pressure to act immediately fades. You have time to reflect, time to review your data, time to confirm whether your edge remains intact. And often, what you discover during these moments of reflection is reassuring. Your process is still valid. Your discipline is still working. The drawdown is simply part of the natural cycle. Once that realization settles in, the emotional weight begins to lift. You stop fighting the phase. You move through it with patience. And eventually, as probability always does, the cycle shifts again. Winds begin appearing. Momentum slowly returns. But something important has changed inside you. The winds no longer feel like rescue. They feel like confirmation. Confirmation that your consistency carried you through uncertainty. This quiet confidence becomes one of the defining characteristics of experienced traders. It is not loud. It is not dramatic. It does not rely on excitement. It is calm, steady, grounded in evidence. And because it is grounded in evidence, it survives the ups and downs of trading The market can deliver a loss. Your confidence remains. The market can deliver a win. Your confidence remains, because your confidence no longer depends on individual outcomes. It depends on your ability to execute consistently across time. This perspective changes how you measure success. Instead of celebrating a single profitable trade, you celebrate disciplined execution. Instead of criticizing yourself for a losing trade, you evaluate whether your process was followed. Each trade becomes a simple question. Did you honor your rules? If the answer is yes, you have succeeded. The outcome becomes secondary. Over months and years, this mindset transforms your relationship with the market. Trading stops feeling like an emotional test. It becomes a structured practice, something you refine patiently, something you approach with respect rather than urgency. You begin noticing that opportunities appear more clearly when you are not searching desperately for them. You see how the market often rewards patience, how movements develop gradually, how alignment across larger time frames creates stronger probability. This is why professionals trust higher time frames. They understand that the market's most meaningful movements rarely appear in the noise. They appear in the broader flow, and the broader flow reveals itself only to those who are willing to step back. Stepping back does not mean disengaging. It means expanding your awareness, seeing the market as a living system rather than a series of isolated candles, observing how momentum builds, how pauses occur, how transitions unfold. When you view the market through this wider lens, your decisions become simpler. You no longer need dozens of signals. You only need alignment with your edge. And once alignment appears, you act calmly, without hesitation, because your preparation already removed doubt. Preparation is the quiet work most traders overlook. It is the process of reviewing data, refining rules, studying behavior across many trades. Preparation turns uncertainty into familiarity. You cannot control the market's outcome, but you can control how prepared you are when opportunity appears. Professional traders spend far more time preparing than trading. They analyze their performance. They identify weaknesses in their discipline. They strengthen their routines. This preparation allows them to act decisively when probability aligns. And when the trade is placed, they release attachment to the outcome. This release is not indifference. It is trust. Trust that their role is execution, not prediction. Trust that their edge will express itself across many trades. Trust that patience will compound over time. When you reach this stage, something remarkable happens. Trading begins to feel lighter. The constant pressure to prove yourself disappears. You no longer carry the emotional weight of needing every trade to succeed. You simply participate in the process, and the process becomes almost meditative. Observe, wait, execute, accept, review, repeat. This rhythm continues day after day, month after month, and gradually your results reflect the discipline behind your actions. Your equity curve begins to smooth out. Your mistakes become less frequent. Your emotional stability grows stronger. The market has not become easier. You have simply become more aligned with its nature, the nature of uncertainty, the nature of probability, the nature of time. Many traders spend years searching for a secret method, a perfect entry, a magical indicator, but the deeper truth is much simpler. The edge is rarely hidden in complexity. It is hidden in perspective, in the ability to see beyond the immediate moment, in the willingness to trust processes that unfold slowly. Higher time frames nurture that perspective. They teach patience. They reduce noise. They reveal the broader structure that short-term charts often conceal. And as you continue walking this path, you realize something powerful. The trader you once hoped to become was never defined by a single breakthrough moment. It was defined by thousands of quiet decisions. Decisions to wait when others rushed. Decisions to follow your rules when emotions tempted you to break them. Decisions to trust probability even when uncertainty felt uncomfortable. Each of those decisions shaped your mindset. Each one strengthened your discipline. Each one moved you closer to operating in harmony with the market's rhythm. And eventually, without even noticing when it happened, you arrive at a place that once seemed distant. You are no longer trying to conquer the market. You are simply working with it. You observe the larger movements. You trust the probabilities. You allow time to do its work. And through that steady alignment, your journey as a trader becomes less about chasing outcomes and more about becoming the kind of person who can navigate uncertainty with clarity, patience, and unwavering consistency.